Assalamualaikum and hi everyone. My name is Nur Athirah Syafiqah binti Mohammad Saufie from JBA 1144G. In today's video, I'm going to explain about evidences of market anomalies. Before we start, I'm going to explain the definition of market anomalies. A market anomaly is a price action that contradicts the expected behavior of the stock market. Some financial anomalies appear only once and disappear, but others appear consistently throughout historical chart analysis. Next, traders and investors can use these unusual market behaviors to find opportunities throughout the stock market. There are several types of market anomalies. The first one is calendar effect. Calendar effects are a group of anomalies that occur at particular times or on particular dates throughout the year. Some theories that fall under the calendar effect are January effect and Monday effect. The January effect describes the pattern of increased trading volume and subsequently higher share prices in the last week of December and the first few weeks of January. It is believed that the January effect is caused by the turn of the tax calendar. Typically, according to this theory, prices drop in December when investors sell off their assets in order to realize capital gains. The increases in January are caused by traders rushing back into the market. For example, one study analyzing data from 1904 to 1974 concluded that the average return for stocks during the month of January was 5 times greater than any other month during the year. The investment firm performed a study analyzing data from 1972 to 2002 and found that the stocks of the Russell 2000 index outperformed stocks in the Russell 1000 index in the month of January. For many people, the beginning of January is simply a popular time to invest. Saving more money may be a New Year's resolution for some, or a way to put year-end bonuses to work. Whatever the reason, stocks typically trend higher at the beginning of January. Next is Monday effect. The Monday effect is a theory which states that returns on the stock market on Mondays will follow the prevailing trend from the previous Friday. History of Monday effect. Frank Cross first reported the anomaly of the Monday effect in a 1973 article entitled The Behavior of Stock Prices on Fridays and Mondays. He demonstrated that the average return on Fridays exceeded the average return on Mondays and that there is a difference in the patterns of pricing changes throughout the day. For example, consider the Dow Jones closes on a Friday at 20,000 and it has been climbing steadily during the last hour of trading. According to the Monday effect, once the Dow Jones reopens the next Monday morning, the upward performance will continue for the first hour or so of trading. From 20,000, the Dow Jones might rise during the early hours of trading. Next is small firm effect. It is a theory that states that smaller firm tends to outperform larger companies. For example, the Russell 2000 has dropped more than 9% over the past year. The S&P 500, meanwhile, is up slightly over that time period. Besides that is earnings announcement. An earning announcement is an official public statement of a company's profitability for a specific time period, typically a quarter or a year. For example, let's say company XYZ is a public company. As such, it must file a thank you every quarter for the Securities and Exchange Commission. At that time, company XYZ will also issue a press release announcing significant components of its financial performance and any other noteworthy items. The last one is PE effect. The price to earning ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. This is a formula on how we can calculate the PE ratio. Next, this is the example on how we can calculate the PE ratio using the formula. In conclusion, even if you do not intend to trade market anomalies directly, it is important that you understand them so that you are not caught unawares by surprising market movement, and you can adjust your trading strategy accordingly. that's all for today's video. Don't forget to give this video a thumbs up and thank you for watching. Bye.